Hello, my name is Craig Cole, and I'm here to talk about selling covered calls. This video will be about 20 to 30 minutes long. We're going to cover some complicated concepts, but I'll try to break it down, make it simple. When I first got into selling options, I was like you, and I thought the premium collected was not worth it, but I was very wrong. And I'll show you at the end of this video the amount of cash that I have collected on this particular stock. This is not to brag. It's just to give you an idea of the potential of this. Like I said, we're here today to talk about covered calls and to give a definition for them. If you find this information useful, please hit that like and subscribe button. I'd love to hear your comments. This is how we're going to start it off. Imagine that you recently bought a house and you purchased that house for $139,000. So you decide to rent the house out for 1 year and you gave the renter the option to buy that house for $140,000. In the meantime, you're collecting rent on that property, aka option premium. Or, sorry, yeah, aka dividends. Let's go with that. Now you collect that for the entire year. Meanwhile, the renter paid you $15,000 up front for that contract, aka option premium, to purchase the house in 1 year for $140,000. Now let's fast forward 1 year, and now the house is worth $172,000. So obviously that renter would exercise the contract and purchase that house for $140,000. Now remember, he has the right to purchase that house for $140,000, but not the obligation. It is totally up to him or them. Now let's say that the value of the house went to the opposite direction. What if it dropped below that $140,000? Then the renter would not exercise that option. And we get to keep that $15,000 whether they purchase the house or not. So you may be looking at it, say, giving the renter the option to purchase that house for $140,000, and now the house is worth $172,000. Sounds like a bad deal. But if you look at it, we got $15,000 right up front. And the renter paid rent all month long or all year long, every month. So, yes, we got paid $140,000 for the house, but we also collected that $15,000 up front. So, the total purchase price was $155,000 is what we collected on that house. Now, if it went to in the opposite direction, it was under the $140,000 and the renter leaves, we get to do it again. We get to rent the house out again, and we have the choice of offering the same contract to the future renter. Now, we could ask for a higher asking price, aka strike price, on purchasing the house, but the fact that we got the money up front, we got cash in our pocket, that's the idea behind covered calls. Now, let's look at an actual live scenario using a stock, and this is real. And the stock that I currently own is NVIDIA. We purchased 200 shares of stock for $139.40 for a total purchase price of $27,880. Currently, that stock pays a dividend every quarter of 1 cent per share, which equals out for the year. I made a total of $8. And I sold two covered call options that expire January 16th, 2026. And I sold those options for $15.15 per share. And remember, one option equals 100 shares. So the total premium we collected was $3,030. This gives us a 10.86% return on our money, whether the stock moves up or down. That's just based on the premium that we collected. So if the stock gets taken, the sale price would be $155.15. Now, how I came up with that number was we sold that call at $140 strike price, and we collected $15.15 in premium. So if it gets taken, our total return on our investment for the year would be 11.29% plus the dividends that we collected for the year, which are minuscule, and I'm not even going to add them into the scenario. That stock is currently trading at $172.36 a share the day of this recording. Now, that stock could be called away at any time before expiration. And January 16th, 2026 is the expiration date. The current option is trading for $42.04. And remember, we sold it for $15.15. The stock is currently up $32.36 from the $140 mark or strike price. So this means that the option still has $9.68 of value still in it. And the rate of decay on the option is 5 cents a day, which is called the theta. And there are 181 days to expiration. Now, if the stock got taken away at $140 a share, I'd be happy with that because I was after the premium. and I got almost 11% return on my money, whether that stock went up or down. So you might be thinking that this is a terrible deal because this stock is trading so much higher than $140 mark. Now, we're not stuck here. Now, we can look at rolling this option to another month and moving the strike price higher. This is called a diagonal roll. But before I do anything like this, I will wait until it gets closer to expiration. Because a lot can happen between now and then, and I have learned over the years it is better to stick with your plan than to change it in the middle. Because when we initiated this plan, we were happy with $140 a share and that almost 11% return on our money. Now, if the opportunity does arise, I will definitely take it. Now, let's look at a diagonal roll and what that would do. We'd have to buy our options back for $42.04 a share. We would then sell to open a June 17th, 2027 $175 strike call, which would give us a 35-cent credit. Remember, each option equals 100 shares. So we'd have a total premium collected of $116 cash. Now let's crunch the numbers here. Is it worth it? Because we would be tying up our original funds of $27,880 for a year and a half. Well, I crunched the numbers. And on this June 17th, 2027 option, if the stock was taken at $175 a share, we'd have a total return of 25.5%. But you got to remember, we tied up the money for 2 years. So that would give us a 12.25% return for each year. Now that sounds good, but we've lost all our premium. We only collected $116 in cash. So we would be solely counting on the stock appreciation at this point, which to me is not a good deal because I'm after the premium to give me the percentage returns on my money. I don't want to hope and pray that the stock goes up. Now what I'll do is I'll wait to see how all this pans out. As it gets closer to expiration, and if the stock moves down, we may have an opportunity to roll this stock option diagonally and collect more premium. But as it stands right now, it would not be a good move. The current stock price is extremely high compared to its intrinsic value. And I understand that this is a growth stock and we're paying for the growth. But again, I'm after the premiums. I am not hoping and praying that the stock appreciates in price. I'm here to collect cash. Paper gains are cool, but I can't spend paper gains. Premium is cash in hand. Don't chase hype, chase cash. Subscribe and smash that like button, that bell, And check out coltechinvestments.com. I have a option selling cheat sheet. I hope you like this video. I will be talking to you again soon. Thank you.